Well, this is a very special interaction we are having right here on ET Now. We are joined by Dr. Nageswaran, the Chief Economic Advisor to the Government of India. Well, Dr. Nageswaran, good evening. Thank you so much for your time. It was a very exhaustive and very educative presentation which you made today after presenting the economic survey and, of course, the big budget which lies ahead. I mean, I heard the entire presentation, also the Q&A later on, but something which caught my attention most, and we'd like to start the discussion with that, you bringing up the Stockdale paradox, where the phenomena of being very confident and having faith about your own trajectory, but at the same time being very cognizant of the reality. In Indian economic perspective, especially with what's happening globally, can you elaborate a little more on where we are standing right now, how we stand different, but yet not to lose an eye on what's happening globally?
I think as far as the Indian economy is concerned, we are very upbeat. And I mentioned that very clearly in the presentation. We have our real GDP is 20% above the pre-pandemic levels. I also added that the high frequency indicators point out that even the current financial year, the first quarter has gone off well. But at the same time, we also have to take into account, that is what I meant by being upbeat, but being aware of the context in which we operate, both from a medium-term perspective and the short-term perspective. The medium-term perspective is what I elaborated in the presentation. The global discourse on globalization, on trade liberalization, etc., have definitely turned south. And geopolitical fragmentation is on the rise, and climate change imposes its own challenges of energy transition and balancing it with energy security. So those are the medium-term challenges. But in the near term, the fact that the conflict in West Asia, the Persian Gulf, is showing no signs of ending, and there are political uncertainties rising elsewhere, and financial markets beginning to turn over in advanced countries, etc., and Indian monsoons being somewhat patchy in terms of geographical distribution, those are the more immediate factors. And that is the reason for me to say that we are upbeat, but we are also aware of the context in which we operate.
And, even the RBI governor just a while back in a lecture in Bombay Chambers Anniversary in Mumbai mentioned that we could be at a cusp of a structural change in growth, where higher growth of Indian economy may sustain for the year, some period of time. You've also brought it up in the economic survey. We heard it from you that 6.5–7% on sustainable basis now should be the focus of policy making as well. Can you elaborate a little more? What are the efforts being done in that direction?
I think I mentioned it also last year in the presentation that whatever has been done in the last 6–7 years in terms of insolvency, bankruptcy code, GST, repairing the balance sheets of banks, etc., and the Real Estate Sector Regulation Act, the ease of doing business in general, all these things are already enough to help us grow for quite a while at 6.5–7%. If we want to build on it, then we need to get the energy transition and the energy security right. We have to ensure skilling and the growth of manufacturing, and also the rejuvenation of the agricultural sector. Then if we do all of those things, then I'm also confident that we can not necessarily grow at 7, but even well beyond that, at 7.5–8%. That is possible if we are able to undertake all the reform areas that we identified in the economic survey.
You also mentioned, in your presentation, the structural shift which is happening in global supply chain, the global trade relationships, and India is also offering itself as one of the reliable global trade partners. And we are, if numbers are speaking for themselves, for electronics, defense, etc. What kind of global trade model would we need to adopt in order to, be successful on the longer term? Not strain our relationship with some of the bigger players, but reorient them so that we don't lose out and we don't give out much more as well.
No, I think that's a very difficult question to answer in a short time frame. I mean, we have been doing free trade agreements. We are opening our markets. We are also reducing our duties, and we also try to become competitive with logistics costs coming down, and also diversifying into multiple trade partners. So our concentration risk in terms of our exports, the amount of goods that we export to the top 10 destinations has come down, which means we are diversifying into different markets, into different product areas. So these are all the ways in which we are on the right track, and in terms of services sector, we are moving into higher value addition. So we are doing the right things, but also, as I mentioned in the presentation, we need the global context to give us a tailwind. And therefore, given that the tailwind is going to be somewhat weaker, if not absent, we have to redouble our efforts in terms of removing the impediments on exports, and also in terms of the private sector finding additional markets, investing in R&D to become competitive in areas where we are still not there yet, and continuing to make progress on both geography and product diversification. That is the way to go about ensuring that net exports also becomes a big contributor to economic growth. Then in that case, 8% growth is attainable.
Sir, when you speak to a lot of bankers, they complain that it appears that a lot of savings, investor savings, citizen savings are actually going to the mutual funds. When we speak to the regulator, she also, sometimes sounds a little perturbed about the surge on the derivative side of the financial market. Just your observation on, does it appear orderly? How do you see it when the economy grows so fast? Is it okay to see flows go to financial savings? What are your thoughts on all this observation?
No, financial savings, household savings going to financial assets is not an issue. In fact, it is a healthy one. It's a question of only talking about the speculative products which are not necessarily helping capital formation. So they are two separate things. So household finances going into mutual funds, but of course mutual funds also will be parking their surplus cash in banks' assets, and banking net interest margin of Indian banks is doing very, very well. It's at a multi-year high, and financial sector profits in general are really doing very well. So there isn't really much there for banks to complain, and it is a competition. Banks have competition with not only themselves, but also with other savings vehicles and avenues that households have. So it's a healthy competition.
The health of corporate India, which is actually reflected in the earnings quality and the momentum, last few years have been very good. What does your data show? That do you see this momentum continue, corporate India's earnings growth?
As long as the macroeconomic environment remains within the country favorable as it is, I think the corporate sector should continue to do well. And therefore, they have the financial wherewithal to be able to also boost employment, undertake capital investments, and thus create the endogenous virtuous circle of demand growth and therefore their own bottom line growth, etc.
Sir, RBI governor says that there are early signs of green shoots as far as rural India is concerned. Do you think some policy impetus will speed up this recovery and should happen?
Why don't you wait and see until tomorrow?
All right, sir, just one last word. I want to understand on capital formation trends which you are observing in the economy. Up till now, bulk of the front loading was actually done by the government side. Do you think there are signs coming in that corporate India is also chipping in, and
yes,
hence
indeed,
the continue?
Undoubtedly, indeed, I mentioned it in the presentation as well. The corporate sector capital formation, if you look at the national income data, had rebounded very well in 21-22 and 22-23, and based on a small sample of 3,000 plus companies, which one of the banks provides us, I think we also are able to see that this growth continued in FY24 as well. And I mentioned in the presentation that outside of dwellings, machinery and equipment and intellectual property products are the two areas which have seen a pickup in corporate investments in the last 2 years, which is very healthy, because that is what leads to high quality employment generation. And therefore, we do see that the corporate sector is beginning to undertake capital formation, and the growth rate has rebounded after a slight decline in 1920 and 2021. It is there in the national income data, and it is also there in the small sample of corporate data available for FY24.
So
I think we have to go here.
Right. So just one last question on jobs. I mean, this is one giant work in progress. Do you think we have done adequate, more is required? What's the perfect, answer for making adequate jobs in the country?
Given the fact that we also estimated that 8 million jobs need to be created every year, it is not that it is something that we can say we can rest back on our laurels all the time, and enough pointers have been given in the survey in terms of fine-tuning our skilling, expanding the scope of skilling, and deregulation in multiple areas of governance, not just the union government, in state and local governments, are needed to continue to sustain employment growth.
All right, Dr. Nageswaran, thank you so much for chatting with us and giving your time, valuable time. Thank you, sir.
If you like this video, then like, share and subscribe to ET Now.